Hi, good afternoon, everyone. I'm Doug Cha, the Executive Director of the Governance Center here at the Conference Board. Welcome to today's edition of Governance Watch, our webcast series hosted in collaboration with the law firm of Cleary, Gottlieb, Steen, and Hamilton. Today we're here to recap the 2018 proxy season. And to do that, I'm joined by four seasoned experts. We'll hear their perspectives on some of the hot topics and trends they saw over the last few months. So first we have Pam Marcogliese. She's a partner at Cleary Gottlieb. Her practice focuses on corporate and financial transactions, particularly capital markets and corporate governance matters. Pam was noted as a rising star by Law 360 in 2015 for her work at the forefront of complex offerings. Next we have Elizabeth Bieber, associate at Cleary Gottlieb, and her practice focuses on corporate and financial transactions. Bill Ultan, longtime managing director of corporate governance at Morrow Sodali, and another veteran of proxy seasons, Jason Alexander, managing director at Okapi Partners, where they do a lot of work for the activist side on the proxy solicitation. A couple housekeeping notes before we get started for CPE and CLE credit. First off, we're offering CPE and New York State CLE credit for participating in today's live program. And to get either credit, you need to stay online for the entire webcast. For CPE credit, you need to enter your full name, email address, and specify CPE in the Request CPE credit space at the bottom of your screen. During the show, 3 pop-up messages will occur, and click OK each time you see one. For CLE credit, you need to download the CLE verification form and CLE evaluation posted in the download section at the bottom of your screen. Complete them. Email them to our friends at Cleary Gottlieb and on the email provided on the form. And I will provide the verification code later in the webcast, which you'll need to write down on the form to earn the credit. And you'll also see that we provided a slide deck from today's presentation in the download section at the bottom of your screen as supplemental materials for this webcast. We hope that you'll participate in today's session. You're welcome to ask questions at any time by entering them in the chat box at the bottom left of your screen. We will work them into the conversation as time permits and respond to any unanswered questions via email after the webcast. You can enlarge the video to full screen by clicking on the 4 arrows at the upper right-hand corner of your screen. You can complete the evaluation of today's session at the end of today's session, and please do so we can get suggestions for future webcasts. And you'll be able to share this program later on with your colleagues as it will be posted on our website for view on demand. So let's get to our discussion about the 2018 proxy season. We'll start with shareholder proposals, everybody's favorite topic. And I'll turn to Pam and ask Pam, what were some of the hot issues you saw in 2018 in particular?
Yeah, thanks, Doug. So 2018 was a very big year for shareholder proposals. It continued to be a very active landscape for that. We saw the beginning of that in 2017 and some in 2016, but certainly it's not showing any signs of abating. One of the most interesting trends that we've seen is that the environmental and social proposals have really increased quite a bit and are now outnumbering by a lot the governance proposals. And that is incredibly different from what we had just a few years ago. Before that trend just didn't exist. And what's going along with that trend as well is the shareholder support for that. So again, back in the day, and that day wasn't even that long ago, these kinds of proposals really didn't receive a lot of support. But what we're finding is that they are receiving an increasing amount of support. And even though they are not overwhelmingly passing with the majority, many of them are receiving a majority. And even the ones that are not are sometimes receiving support in excess of 30 or 40%, which is not something that companies can easily dismiss, especially with some of the new guidelines by ISS and Glass Lewis that are suggesting that companies really do need to pay attention to support received on these proposals at certain threshold levels. Finally, I guess the other thing that we're seeing in terms of an overall trend this proxy season is the use of these proposals as a way of engaging companies. So engagement is a big issue across the board, but shareholders leveraging these proposals as a way to engage management, to force conversations with management, and sometimes as a quid pro quo. Not in every case, but sometimes as a quid pro quo, shareholders are willing to withdraw the proposal if they feel that the companies are appropriately engaging. So those are kind of the overall themes that we've seen this proxy season. I think more granularly, so on the environmental side, that last year I think started, you'll all remember, with Exxon Petroleum and, Exxon and Occidental Petroleum, right? And both of those getting support on majority support on those shareholder proposals, which was unprecedented because in the past similar proposals had consistently failed, and that was really as a result of some of the bigger institutional investors getting in there and supporting those proposals for the first time. So on the heels of that, we've seen a lot of companies just spontaneously follow the lead there and put out their own reports or commit to putting out their own reports on climate and environmental type issues. Even beyond that, just across the board, what we've seen is there were 9 shareholder proposals this year in the environmental space that received more than 50% shareholder support. And in terms of some of the other ones that didn't receive more than 50%, I have some stats here, 41% got more than 30% shareholder support, which was 10% more proposals than in the prior year that got supports at that level. So that's a trend that's sort of just increasing.
So a couple interesting things on that, Pam, to build off of. So I think many institutions are thrilled not to be talking about proxy access and written consent and special meeting thresholds anymore. With the exception of proxy access, which they're totally fried on, most of these bylaw charter provisions have been around for decades. They have very stable policies on them. But the challenge on the environmental and social issues is that unlike bylaw and charter issues, which are fairly generic and institutions can have generic policies on, this is a real challenge for the investors to look at these matters in a very company-specific way. And I think that leads to some of the results that you've seen, that for the companies that either received a high level of support in the past or were anticipating this issue and were able to get out in front of it, they were able to deal with this issue. And I think the actual quantity of some of the 2-degree proposals and distributed generation proposals is actually lower because of that. And it's funny, Doug introduced us by talking about the 2018 proxy season, but I think we would all concur that the proxy season now is sort of 12 months long, right? And so a lot of the work that companies are doing around environmental and social issues is what happens before the proxy is ever put out. And I think that it very much ties into the strategy of how to manage these shareholder referendums. If you're positioning yourself well in advance, then you're much less likely to become a target.
And to build on what you're saying, Bill, is one of the things that we've noticed is companies that don't pay attention to their disclosure, and especially in the smaller mid-cap companies, you may be doing these things, and you may be going, and you may actually be LEED certified, and you may be doing proper environmental reporting and have a group in your company that does that, but they're not talking to the legal group or the investor relations group that is responsible for putting it on the website. So make sure that your disclosure is up to date and you get it on your website to make sure that investors can find it, and that may keep you from having a shareholder proposal in the environmental space.
And we're also...
So, Lisa, I guess there was some pretty big surprise situations that were controversial on some of these votes. I know, at GE, AES. Maybe you want to just take us through and highlight some of those for the audience.
Sure. So separate from the shareholder proposals, there were a couple instances this proxy season that delivered a couple of surprises. The first one was at GE with their auditor ratification vote. That was, and ISS and Glass Lewis did not support the votes to ratify the auditors, and it resulted in GE receiving less than 70% approval for their auditors, around 64.9% approval threshold. This was surprising. There were in 2017, I believe, around 15 companies that received significant votes against their auditors, but GE is one of the largest. One of the things that was implicated and is most interesting in ISS and Glass Lewis's statements against the support was noting that the long tenure was implicated. And so that's something that we've heard in past proxy seasons and in past governance concerns relating to directors, that director tenure can be implicated in their independence from management after a significant period of time. But this is one of the first times we've heard that the tenure of an auditor could have the same kind of implication.
At least it's typically been very narrow focused, right? It's usually pension funds and people like that focus on those kinds of tenure issues. This was way more broad-based.
Right. This was extremely broad-based, and I think the numbers reflect that. And given some of the ISS and Glass Lewis guidelines on responsiveness, it puts some pressure on GE to also figure out what they're going to do in response to such a significant block of shareholders voting against their auditors.
It's also interesting that, the ratification of auditors is really a voluntary thing at most companies, I believe. So I don't know if we're going to see a movement to take that off the proxy. I mean, people just thought it was kind of a formality, rubber stamp, but now that there's some controversy around it, maybe some companies think twice about this as a voluntary matter.
That's a good point, Doug,
Lisa,
but I
what
think
about,
you're going to have a problem with your quorum then if you
Yeah.
if you decide to take your auditors off. That's one of the few remaining routine proposals.
Yeah. Plus, I think a lot of investors.
well, that's what we have the proxy solicitors for, to get the quorum.
We're happy to help. We're happy to help, Doug.
I just.
Your job just got harder, but you also keep yourself in demand, right? So anyway, what about Lisa, AES? They had an interesting situation there that was also pretty controversial.
Yeah, so AES was a little bit of a 1-2 punch. They had a proposal that many companies received this year, which was to lower their threshold for shareholders to be able to call special meetings to a 10% threshold from Chevedden. This was a favorite of the proxy season this year. But AES's tactic for opposing this was to ratify their existing 25% threshold, which enabled them to seek no action relief, which they were granted. So they were able to exclude the 10% threshold proposal from their proxy statement. This was interesting because it allowed an existing bylaw to just be ratified by the shareholders, but it also had the effect of creating some knock-on effects. So there were investor groups that were unhappy with a company using their existing bylaws as a mechanism to seek no action relief and receive no action relief, which some investors felt disenfranchised shareholders. And the second thing that happened as a result of this was the proponent, Chevedden, didn't take this sitting down. What he did instead was he put in a solicitation with the SEC and ended up filing under AES's Edgar page his feelings on the proposal and let folks know exactly what he had proposed and why he opposed the company's ratification proposal.
That's pretty interesting. I don't know if it's a one-off, but it's certainly different than some of the preemption cases that we've seen in the past few years. It's also been controversial. In terms of proxy season and shareholder proposals, one of the anticipated developments was how the SEC was going to carry out the staff legal bulletin 14I, which talked a little bit about including some description of the board level analysis of shareholder proposals in the company's no action request letters. How did this play out? I think a lot of people are very curious in terms of the disclosure around board level analysis and how the SEC looked at that. Pam, maybe you want to give your summary and analysis of
Sure.
that.
So I think when the SEC put out the staff legal bulletin, people were very optimistic that this was a sign by the SEC that they would become more lenient on that prong and allow the exclusion of more and more proposals on that basis. It turns out that that's not quite how it played out. And if you, I recommend, this is a plug for our own firm, but we put out an alert memo, and I recommend to your viewers that they take a look, because we created this scatter plot where we mapped out basically whether or not the SEC granted no action relief and what some of the characteristics of the proposals were. And if you take a look, there is a little bit of a story that emerges, but you also see that there are a bunch of inconsistencies along the way. And I would say that some of the top issues that come out of it is that the SEC is still very much focused on the substance of the proposal. If the SEC thinks that really it goes to micromanaging of the company, it is much more likely to allow the exclusion of it. Whereas if it really relates to a significant policy issue, it's a lot less likely to allow for exclusion of that proposal. And you look at those two prongs, and it is very much irrespective in many ways of the strength of the board analysis. And in some cases, it allowed for exclusion even if there wasn't board analysis, which seems to be a little bit different from the indications that had been sent forth in the staff legal bulletin. So it seems like that was a very big area of focus. And the other trend that seems to be emerging is really the shareholder support for the proposal in prior years. So in instances where shareholders seem to have significant support for that kind of proposal in prior years, the SEC was a lot less likely to allow for the exclusion of it. So all of that is very interesting. And I think we heard recently from the SEC that they are still thinking about how the application of this should look going forward. So I think they themselves are figuring it out, which is great, because I think this leaves companies with a lot on their side to figure out as well. I don't think, if I had to write a no action letter request today, I think that, the path forward isn't all that obvious, other than the few things that I mentioned. But I think this is really is going to be a big area of focus in future years, because getting the board together to come up with this analysis was something that a lot of companies tried to do, and it's very difficult to do that. As you know, it didn't always coincide with sort of the regular board meetings, and so it's quite cumbersome of a procedure for companies to do.
A couple points in response, Pam, that what we were talking about earlier about how shareholder proposals are getting much more company specific, and so now companies are managing what I would call a baseline of disclosure on various environmental, social issues. What will be interesting to see is, because we know how these trends move, that as the demands of these proposals change, so okay, you've done the baseline level of disclosure, but now we want you to go further. We want you to do additional disclosure, and at some point, does it get into more of an ordinary business or economic issue where maybe you can have more traction with no action relief? And I think that'll be interesting to see. Two other
but it seems like with some of the proposals that already were allowed to go through and got a considerable level of support, the SEC essentially said that kind of takes precedent over whatever board level analysis there's been. So I'm kind of wondering, in the future, companies are going to be able to evaluate, all right, what are our chances? Is it worth going for no action? And just looking at prior level support, it might not be worth it. And therefore, it might not be even worth putting the question before the board and spending all this time, having them meet, and then writing all that disclosure. And so I think we'll see, like all these things that the SEC comes out with, in kind of the interest in trying to make their lives and decision making process simpler. They just make it more complicated every time and make it harder for them to get out of this this business of using subjective tests. There were a couple, Pam, maybe you want to talk about some of the specific letters. I know that there were a few winners and many more losers on the company side.
Yeah, so I mean, in terms of the specific letters, I think it really just depended a little bit on what day. It felt like it depended a little bit on what day of the week the letter was responded to. So there was an instance where, for example, Apple got they got approved, their request got approved, and then there was another one that came after it that sort of relied on it and basically said, well, in Apple, you all decided that this wasn't a significant business issue, and so the SEC seemed to also approve that letter. But what was interesting is in that letter, there was no board analysis whatsoever. So this, it's still a little bit unclear, and I think that for the moment, there are interesting things to be gleaned from the way the responses have come out so far, and they do provide a little bit of an indication in terms of a path forward if you had to write a no action letter request right now, but I'm not sure that they really tell the end of the story just yet, because I think that both on the company side and the board analysis side, but certainly on the SEC side, this is all going to really shift, and I don't think we have a clear indication yet as to how it's going to shake out.
And I would think it also is going to depend on your board. What is their inclination? Do they look to fight right away? To Doug's point, do you bring this to the board that might have a feisty perspective, and they say, hey, we don't like this proposal. We're going to fight it. We're going to fight it all the way. And that may be advisable, and sometimes it's certainly not.
Well, to what we were discussing before, that's actually really interesting, because when we've had conversations with companies either about writing a no action letter request or about including it in the proxy statement and writing an opposition statement, you've got people poring over this stuff that you're writing, and so you don't want to further upset your shareholders by taking positions or making arguments in either your opposition statement or the no action letter request that then upsets your shareholders further just because you're trying to get your no action letter request approved. So it puts you in a very awkward spot in terms of what you say, what the board, has deliberated about, and you therefore describe in the letter, and that sort of has to, even if you're in favor of environmental issues and your board's in favor, in order to do the no action letter request, you might be put in a situation where you have to say certain things that may be less appealing to your shareholders. So there's a complete calculus that goes into
it's sort of
what
choosing your battles, right?
Exactly.
And as advisors, we're all used
Pam,
to seeing different types of boards, Jason,
Yes,
right?
sure.
Ones that are more compliant and others that are not.
That's a great point. I want to move on to one development that this year it looked like there were more use of notices of exempt solicitation. Jason, I was just interested in your take on that in terms of why that's the case, why even use one of these things in the first place. And so, any take on increased use of exempt solicitations?
Sure. Well, I mean, Doug, it's certainly not an uncommon thing. They've been around for a while. You see a lot of the public pension funds have utilized them for a number of years. When the proxy access proposals became common, you saw with CalSTRS and CalPERS coming out on behalf, New York City coming out, Scott Stringer coming out on behalf of these proposals and utilizing that facility. I think the interesting example is what Lisa was speaking about before was AES. AES, the way that Cheveden used it, the way my understanding of Rule 14A6 is that you need to own $5 million worth of that corporation's securities to be able to put forward an exempt solicitation. And I don't know Cheveden well, but I know him well enough to know that he doesn't own $5 million of AES. So it's interesting, and I would ask the lawyers in the panel to say, how was he able to participate using an exempt solicitation, not being a $5 million owner of AES's security?
So interestingly, I don't think there's anything that prevents you from filing it as an exempt solicitation, and that seems to have borne out in many other situations where we've seen these pop up, and we don't think the folks own more than $5 million of securities. So I think the downside of it is that you can essentially put up something on the company's Edgar page, as Lisa was mentioning before, that isn't really bound by that many rules, and allows somebody to get a little bit more prominence in terms of what those statements are, because it's publicly filed and it's accessible and it's a writing, so it can be forwarded and disseminated as opposed to just statements. So it gives a little bit more prominence to his views, or anybody else who does this.
And unlike in the 13D and 13G world, where you might have similar filings that are distinct in that they say exactly who the filer is on top, and they make it clear who is speaking. When you file a notice of exempt solicitation, it can be a little bit tricky to figure out for perhaps an unsophisticated investor exactly who is speaking, because it's not clear that it's coming necessarily on behalf of an investor or someone else.
Because typically people aren't going to understand, an unsophisticated investor aren't going to understand if the corporate banner isn't there on a proper filing, that it's not coming directly from the company.
Exactly.
So Jason, before we move on, just maybe a word about virtual annual meetings, another a topic where there's been a lot of noise around this the last year or two.
Well, Doug, I think noise is the absolute correct term to use. So for those that are unaware, and I of our audience, I'm sure no one is unaware, but virtual only meeting is basically a meeting that does not have a bricks and mortar place. There's nowhere for shareholders to go. They're participating via a webcast like this, a conference call, and they're should be able to ask questions via some type of portal, as you can ask questions here. They continue to rise in prominence. I think there were 127 this proxy season. Well, to Bill, so far in this proxy season. Right. There are a growing list of organizations who are absolutely opposed to it. CII being one of them, the New York City Comptroller's Office being another. We saw a lot of pressure put on ConocoPhillips and CSRA, who had virtual only meetings previously, to actually have bricks and mortar meetings again, and they reverted to both doing that. I believe the way that Intel does it is Intel actually has an in-person meeting, but you can attend via webcast and still ask questions via portal, which I think if you're going to do it, especially as a large corporation, that's absolutely how you want to do this.
Yeah, I'm not sure Intel still does that. I know they used to, but I participated in the one this year, and I believe it was virtual only, and they did a really good job.
Well, I was going to say one other point that I wanted to make, Doug, regarding that is my understanding is that in 2019, ISS is going to actually start withholding from nominating governance committees at companies that have a virtual only meeting that haven't done a robust disclosure on how shareholders may participate and given shareholders a number of avenues to be able to participate in the meeting. So that's something for our audience to be aware of.
Okay, well, I guess it was just a matter of time before they were going to chime in on this or even get more serious and make recommendations. Let's move on to some of the specific issues and the substance. One very hot topic these days is board composition and board refreshment, and diversity ties into that. Pam, there's been a lot of talk about that. Is this talk and pressure actually making a difference?
Yeah, I think it is making a difference. I think that there are a lot of companies that are really focused on refreshment and board composition, and it shows in many different areas. So I think a lot of companies are having conversations about the composition of the board, the tenure of the people on the board, the skills of the folks on the board, and making sure that they take a look at that. I think that from a refreshment perspective, it continues to be very difficult in order to make change. But I think that when people do step off the board or retire, the people that they replace them with, people are being more thoughtful about these kinds of issues and making sure that they are thinking about diversity of gender, of race, and also a skill set and a variety of other things. And so I guess what we've seen is people just thinking differently a little bit about board members. So for example, one of the trends we've seen is a different conception of what it means to have C-suite experience. It used to be the case that it was really CEO or CFO. Now I think people are taking a broader view of what that might mean, which allows for more diversity in the process, because if you really limited it to CEOs and CFOs, I think that by definition, you just get less diversity in that group, at least as of today. The other thing that people are thinking about is also technology. As everything becomes more digital and more mobile, thinking about sort of the age of the directors on the board. Sometimes focusing on more junior directors is a good idea. Also to have a representative voice for millennials. If you're a consumer brand or you're selling to millennials, having that perspective is also something that companies are looking at. So I think it's bringing about diversity of age on the board as well. So what we've seen in some of the stats is that just about 50% of the new directors that were added this year to the S&P 500, that's the set where the stats are based on, were either women or minorities. So over 50%, just over. That's not a terrible place to be. But if you look at sort of the overall percentages, the numbers are moving very, very slowly because your denominator is so large. So for example, we were at 22% of those board members at S&P 500 companies are women, which is only up 1% from 2016. And same for minorities, it's at 17%, up 1% from 2016. So again, the trend is in that direction, but the numbers are moving slowly.
Yeah, and I guess one good indicator that companies are really thinking about this is the number of, or the proportion of new the empty director seats that have been filled has for being filled by total newbie first-time directors. That number has increased. So I think that's a pretty good indicator that companies are making an effort to think outside the box and kind of look beyond, the typical neighborhoods that they're looking at for corporate directors. Bill, one question here is where do the large institutional investors stand on this issue in terms of board composition and refreshment? We know that the New York City Comptroller has been very vocal and very active, but what about beyond that in terms of some of the other non-pension institutional investors?
Sure. So I think most large institutional investors are more pragmatic in their approach to board composition. First, as a precursor, I should say, performance is an overlay to all of this. And I think board composition is very different when looked through the lens of an underperformer versus a company that has outperformed. Having said that, most large institutions absolutely embrace the concept of board diversity under the guise that this is primarily a deliberative decision-making body, and as a result of that, we want a diversity of perspectives and experience to bring to bear. It feeds into the risk management role that the board plays, and so I think most institutional investors are very supportive of that, but they're not overly prescriptive. So I don't think they want a board to check certain boxes off just for the sake of checking them off. Efficacy is everything. And that's why I say ultimately it gets back to performance. But I think what we'll find in the years ahead is that both active money managers as well as the passive quant firms are going to look very much at specific topics that companies have to manage. And again, it gets into some of the shareholder proposal issues, but also more fundamental operational matters, and understanding the board's role in oversight, in challenging management. Are they asking the right questions? And to do that, you need more than just general criteria, general characteristics of the board. You really need to understand, do these directors know what they're talking about? Are they up to the task of really challenging and assessing management? And I think that's where this trend ultimately is going. It's not just going to be around checking boxes, but it's really getting to the substance of, are directors doing what they're supposed to be doing?
But it's also an area where companies have to be a little bit careful. Pam talked about this with shareholder proposals, but being careful about the rest of their stakeholders. So we saw an instance this year where Amazon had a proposal to institute something like the Rooney Rule for their directors, and they opposed it in their proxy. And their employees and other investors read that statement of opposition and said, what do you mean you oppose diversity on the board? We think that you ought to do it. And Amazon ended up adopting the Rooney Rule before it even went to a shareholder vote, because they ended up taking stock of their other stakeholders. So it's an area where companies also have to be a little bit careful as they analyze what they're going to do in this area and think about what other stakeholders will have a voice and how their actions will reverberate both outside the boardroom and outside of their core investor base.
And
I would say
Bill,
look at
Yeah, Lisa, I think bringing up Amazon is a really good illustration of how, the new generation of employees really expects more from management, and the fact that any employee picked up the proxy statement and read it and actually got interested in corporate governance, to me is amazing, because I used to write these things just, assuming that no one read it except for, people in our nerdy little crowd.
Just on that though, one of the things that's really interesting is that on a lot of the issues that are the subject of shareholder proposals, they turn on very social issues that, extend beyond just the shareholders at the time of proxy season. So for instance, you have the whole gender pay equity, which was the subject of many shareholder proposals, but it's just also a topic of conversation in hallways at companies across America and frankly across the world. So it's not necessarily surprising that on issues like that hit very close to home, that employees would pick up the proxy or get the information however they got it on these issues, because it's very much something that impacts their daily lives. And that's really also maybe a little bit of a shift in terms of the subject matter of these shareholder proposals, is that there's almost a little bit of a private ordering going on in some of the policy issues that are going on a national or global scale, are also being brought into companies through the shareholders, through the employees.
Yes. absolutely happen.
But as you look, as a company,
Yeah,
as a company
in
matures and
Amazon's
changes,
case-
sorry, Doug, as a company matures and changes, the needs inside the company are going to mature and change. And look at now that companies are out there looking for cybersecurity experts to sit on their boards of directors, and those people are frankly not going to be 72 years old. They're going to be significantly younger at least, and quite likely be a person of color and or a woman. So those are all positive developments.
So that, I guess those are some instances of the company perhaps self-correcting. In terms of some of the institutional investors, some of them came out with pretty big talk over things like ESG and diversity. Obviously, New York City Comptroller, but some of the other, what you would call mainstream passive investors said, look, this is what we care about, and if we think that you're not taking it seriously, there will be some consequences. Bill, did they actually kind of back up the talk with actions and either votes or some other way?
Well, I think they backed up their words through their methodology of voting. I think the big institutions continue to be challenged by capacity. I think their intentions are there. I think they want to engage. I think they want to evaluate companies on as subjective and specific a basis as possible. But they have 10,000 proxies to vote each year, and they can't. Now, I know a number of these firms are hiring people or are growing their teams, and that this goes to everything we've been talking about this afternoon, that for this governance environment to really be successful for both companies and investors, both parties have to do their end, right? So the companies are doing more disclosure, certainly more than ever before. They're engaging, they're reaching out to investors. But now there's a burden on the investors, right? They have to step up. They have to develop that capacity to engage, to understand companies. And it's Jason, I'm sure you've had the same experience when you first talk to a client who's not done this before, that yes, you want to go talk to the big index funds around your capital allocation strategy and your fundamental business model, and the looks you get from those companies, like, are you kidding me? You want to talk to an index fund about that? But that's where we're at today, and I think that's only going to continue, which puts now I think the companies right now are showing, for the most part, that they're stepping up to do this. Now let's see if the investors are. I think Vanguard, State Street, BlackRock are certainly starting to do that. Some of the big active managers are doing that. But in my opinion, they need to continue to work in that and do more.
I think.
Well, I guess also the flip side of that is, the directors. And so there's been a lot of talk about shareholder engagement, not just company engagement with investors, but specifically getting directors out there and in face-to-face meetings. And a lot of directors say, hey, look, that's not really part of our job description. At least it hasn't been for the last 100 years. And so, but now it is due to investor demand. So, Jason, what did you see in this area that seems to be still emerging, in terms of the practices? Did we see anything kind of solidify or become typical, or people get creative?
No, those are really good questions, and kind of a nice segue from what Bill was discussing. One of the things that we saw, and this started a couple of years ago pretty much with State Street. State Street started asking directly for a director to be involved in a conversation. Typically, it was around compensation. We had a situation with a client where they did not feel comfortable putting a director forward, and State Street then said, well, thank you, but no thank you, then we don't want to have a conversation with you. Conversely, this year we had another client who had a brand new CEO, was given a significant grant. Now, the CEO was only in the chair about 11 months. The stock was up 95%. It was a drug type company. He was brought in specifically to bring things to market, to complete production, go through FDA, and bring things to market. And the conversation would have been very different had not the head of the search committee from the board participated in these conversations. And he was able to walk the investor directly through the process. Here's what we did. Here's why we chose this candidate. And here's why we chose this specific person and why we gave him this much money, because in his history and the research that we'd done on him, he'd never sold a single share of any company he'd ever been involved in. And that for them was a very, very different perspective. The director said that was how he said the CEO was basically treating himself like an investor also. He was in it for the long haul. He had significant skin in the game. And I don't think that would have been transmitted as well or translated as well for the investors had not that director been a part of the conversation. It's almost like you're don't pay any attention to that man behind the velvet curtain. And you are now behind, the investors are now behind the velvet curtain with the director taking them step by step through the process. I think it was very enlightening for the directors, and I think it's actually a great opportunity in that perspective. I don't know that you roll directors out for everybody, Doug. I don't know that if it's your number 20 institution that owns less than 1% and they say we want to talk to a director, I think that's a very slippery slope that you're getting on at that point, and I don't know that you necessarily want to go there.
Yeah, well, I guess I understand what you're saying. But I also historically took the view that just for the director's own education, it might be good for them to visit with a whole variety of types of investors, and those might be lower down in the rankings of ownership.
And that goes to the question,
but,
though,
what you said
do you have investors or do you have directors participate maybe in your investor day? So you're having an investor day run by investor relations. Is it good to have 1 or 2 or 3 independent directors participate in the day and be part of a session with the analysts or the PMs? Which is not necessarily the same group that we're talking about engaging with, but I think is also beneficial for the directors.
Well, also, I think the what you just illustrated in terms of this director walking the investors through the decision-making process around the succession and also the stock or the options award or stock award or whatever kind of award it was. That also raises the question of, should companies start thinking about writing disclosure about that? I know a lot of investors are saying we want to know more about, kind of how we want to know more about what goes on behind the curtain. And this could be an example where, if lead director, independent chair had written a letter and stuck it in the proxy statement explaining all this, maybe actually, can preempt some of this engagement. And so in terms of engagement, people talk about how now it's a year-round activity. Bill, you mentioned at the beginning of the program that this never stops. And so as companies start to move into this off-cycle engagement period, some try to do it over the summer, others kind of ramp up in the fall before people even start making decisions. What are some things that you would advise companies to do, over the summer and the fall engagement periods?
So everything we've been talking about, right, it gets into communication with shareholders, having them understand board decision making. Having said that, and understanding how critical these discussions are, again, it's not one of these check the box, okay, I engage thing. Sometimes I hear companies talk about engagement like they're taking their daily vitamins. Oh, did you engage today? Did you engage today?
The check the box theory, so I can put it in my proxy next year that we reached out to people owning 70% of our shares.
And that is not the right approach, that this needs to be a substantive approach. This needs to be thought out in terms of each year. What topics do we want to cover? Who do we want to participate? What is our risk profile? What risks are we trying to manage? And then the off-season engagement, and we have to put quotes around off-season, right? But the off-season engagement is incredibly impactful, and I would argue is far more important than what happens once the proxy is out. Because if you are effective at the discussions and the communication and the disclosure enhancements during that off-season period, you are far better positioned to have a smoother solicitation.
I think we're also seeing the investors do it a little differently, right, in the off season, where they're now saying, okay, we were looking at, we cover 12 industry segments. Mm-hmm. We're going to try to meet with these 4 this year in the off season, and then meet with them specifically on issues during the season.
That's right.
And then I think that's become effective, and that's becoming more common, especially with the big 3.
That's right. And as
Yeah, that is interesting. Sometimes these investors, they'll target a specific industry to look at for in a particular year during the so-called off season. At this point, I want to give the audience the CLE code, verification code that you'll need to write down on the form before you send it back. The verification code is 11537. 11537. So be sure to write that down. Another topic, everybody's favorite, and we read about in the paper a lot, activist investors. And so, Jason, you are probably particularly close to some of these activists. Maybe you want to highlight some of the trends you saw this year, coming from their perspective in terms of different approaches that they might be taking this year as opposed to prior years.
Happy to, Doug. And just for the record, activism is only about a third of our practice. We actually do work with a large number of companies, so not to think that we're out to get anybody. So right now, this far, and this is through June 30th, there have been approximately 610 companies globally that have been approached or pursued in some activist manner. Whether it's just a D was filed or just a letter was filed, or it's gone all the way to a full-blown fight for seats. I think the most interesting thing that happened this year, and I think Bill might agree with me, was Procter & Gamble and Triad. That was, the behemoth that went on this year. And I think the thing that proved to us is companies with a significant amount of retail or beneficial shareholders can be particularly vulnerable to an activist that not only has a good thesis, but has the ways and means to wage a battle. And what we've heard rumored, and Okapi did not work on this, I don't think Mara worked on it either, but the rumor is that P&G spent $100 million, maybe more. Triad spent about $25 million. And at the end of the day, Peltz still got on the board. He lost a seat by, I think, 28,000 shares. So I think that was a significant learning experience for a lot of companies. And what's trickled down from that is what we've seen is the number of settlements this year is much higher through June 30th than it was last year. I think 60 campaigns settled in 2017, in halfway through 2017. This year it's over 100 with 167 seats being awarded through negotiated settlement. So that's a significant difference and more of a, I guess, I don't say camaraderie is a terrible word, but an opportunity to see your way past what the true difference is and be able to work together for the benefit of everyone. Because at the end of the day, a shareholder contest is very costly. I think one of the other reasons we've seen more settlements this year is less CEOs have been targeted than in years past. And obviously, when you're targeting a CEO or trying to replace a CEO, it's kind of an all or nothing. There is no middle ground. Either you want her out or you want her in, and there's really nowhere to go with that.
Nobody is kind of fired. They're either, they're alive or dead. So one thing that the activists came out, or some of them were publicly talking about is their embrace of ESG. Naturally I was a little skeptical because we've had private conversations with hedge funds where it's pretty clear that ESG is not really part of their investment thesis. So, Bill or any of you, what are you seeing in this area? Is this for real, or is this just kind of something that we don't really know where it's going?
Well, I would actually point to two examples. First, Jana Partners paired up with CalSTRS, and put forward to Apple that Apple needed to have much more stringent controls on its phones to protect young users, and I thought that was very interesting. And then Jana and ValueAct have both launched funds with an ESG bent to them. Now, ValueAct not necessarily they're a big value investor, and they're not as the agitator that they used to be, but they definitely have the presence in the market. I would also sort of point to you in a spin on that to look at diversity. Look at what the folks who went after Destination Maternity did. 3 of their 4 board candidates were female, and they ended up putting the former CEO of Land's End in the CEO chair after they won all the seats on the board. So I think that's a significant turn. And so they were first time activists, but I think it shows that not necessarily. And to your point, Doug, I don't know that there can be a bit of skepticism to how much that they are committed to ESG and or diversity. But I think if it helps them put forward their thesis, they're willing to use it as a tool that's in the box.
Not all activists are cut from the same cloth anymore, right? So,
No.
and there
You
wasn't
have the reluctant activists and the people who don't, and this, that, and that
That's right.
destination fraternity, that was the case. Like, you pushed us to this. We didn't want to go here. We wanted to work
Right.
with you, and you didn't let us go.
Right, and for several years, one of the primary vulnerabilities of companies was capital allocation and more strategic, and companies have been focused on that. So now maybe activist focus will move elsewhere. Maybe it moves into more environmental, social issues. And that's really the key from a corporate risk management perspective is there is a breadth of exposure here that needs to be managed and communicated and thought through. And because activists can come in many different shapes and sizes.
And to your point about pushing for support for their agenda, there are lots of other shareholders that are very much in favor of these issues. So if you're trying to garner support from a huge chunk of people because you need to get out the vote, putting forward some kind of ESG platform that those people can sign on to is also very helpful.
Certainly, you're seeing it in the investor space too, but where ESG intersects with strategy, you have a lot of attention both from activists and from your largest investors, and that's an easy way to marry the two. And I think in those instances, there really is a lot of dedication, and there is a lot of truth behind what both activists and investors are focusing on.
And I think that's why you won't see environmental and social proposals go away. They'll always be the governance proposals, as Bill said, the kind of the uninteresting proposals. But they go to the longevity of a company, the business risk that goes on with running a company, and can you continue to create shareholder value if you have this kind of sword of Damocles hanging over your head, regardless if it's an environmental or a social issue.
Yeah, I think it's important to distinguish between, for ESG, some people look at it as, companies are trying to really promote some kind of environmental practices of, kind of what people would call like the tree hugger type stuff. But I think a lot of the investors are starting to look at ESG and sustainability as really, from a risk mitigation point of view. Climate change is real, whether you agree it's man-made or not, but it's going to impact a lot of businesses, and what are those businesses doing to mitigate or to change their business model to avoid this kind of thing. One thing that I found interesting from this year was that the big three investors, BlackRock, State Street, and Vanguard, all came out with fairly broad, aspirational statements on big societal issues, talking about, the social purpose, ESG, diversity. Lisa, these statements got a lot of attention. Did these firms, was there any evidence that they were actually backing it up in terms of putting pressure on companies beyond just issuing letters directed at CEOs?
Well, I think we've heard both from clients and from the investors themselves that there is a focus on this. So one of the ways that this plays out that we've seen is through the engagement. And as Bill said, it's not really a check the box exercise, and companies ought to be careful as they go through these exercises that if they treat it as a check the box exercise, that they could end up doing more harm than good as they go through these engagements. Because what we've overwhelmingly heard, and as we've discussed, is that these engagements really ought to be focused on the long term, on strategy. And as all of these topics coalesce towards a long-term strategy and implicate how a company sees itself going forward, these investors really do care. And so handling these kinds of engagements poorly can lead to skepticism from the investors and can ultimately potentially lead to no votes for directors and a lack of support from investors on a go-forward basis. So I think that companies really ought to be mindful of the kinds of messaging that are coming from investors and thinking about how they're engaging, thinking about what they're saying in their proxy statement, how they're addressing these issues on their website, and what else they're doing in these kinds of areas and spaces, and making sure that they are attenuated to the most critical concerns of their investors. And in some ways, it's nice that the investors are giving a roadmap in some respects, that they're putting it out there and they're saying exactly what they want. And so you can measure yourself against it. If you look back 5-10 years ago, it was a little bit more of a guessing game, and if you didn't get in front of an investor, you might not know what their key issues were. But here, at least, there's something where you can bring it back to the boardroom, you can bring it to management, and you can say, look, these are the things that our investors have said that they care about. If we're not addressing them, why aren't we addressing them? And if we are addressing them, are we doing a good job in doing so?
I think the thing to add on that too is I don't know that they're looking for change immediately, and they're certainly not looking for change's sake, as you say. They're not just to check the box, but they're also saying that, hey, maybe not this year, maybe not next year, but in 2020 we will be voting against your nominating governance committee directors because you're not paying the mind that needs to be paid to these issues.
And we sort of saw that with those examples of the climate change proposals for Exxon and Occidental Petroleum. So we weren't involved, but from some of the statements that you can read in the press, it seems like Vanguard and BlackRock had been engaging with the company for several years. And as I mentioned earlier, those proposals were on the ballot for several years, and they were not voting in favor of them. But I think, according to the press reports at least, they eventually got frustrated that the progress at the company on those issues wasn't being made fast enough, and so then decided to vote in favor. So to your point, it's not change for change's sake, and it's not voting for voting's sake. I think there are some issues that they really do care about, and what they want is for companies to actually just engage and make progress on it. And so I think they are taking a bit of a longer view. They are giving companies the opportunity through engagement, but I think they do expect to see something happen at companies if they feel strongly about certain issues.
They're fully involved now. It used to be some of these large passive funds would abstain on some of these proposals because for whatever reason they didn't feel they had the expertise or they wanted to show deference to the board. That's no longer the case.
Now they've brought on the expertise. So now the State Street in particular brings on their own environmental experts on the phone, and we've engaged with some of our utility clients with them, and they have their own people who are asking tough technical questions, and you need to have your environmental expert on the phone because the rest of us we just glaze over. We go, what? I don't even know what that means.
And to a utility or an energy company, these are existential issues that are core to who these companies are, and that's why I think I'm optimistic of where the path is going in the governance space because the companies have no choice but to really engage. The key is for the investors to really do their part and understand the companies, understand the risk. Not all utilities are the same.
Nope.
Not all energy companies are the same. Retailers are different for risks in that space. And I think that's going to be the challenge going ahead is for these large passive investors that have never had industry analysts before, right? Are they really going to focus and develop that type of capacity that they haven't had in the past?
Well, I think that's one of the
I think all of this. I think these are very good developments, and it shows that leadership from the very biggest investors can really make a difference. Even if it's just one or two specific leaders, like a Larry Fink, when he speaks, it does make a difference. So it's a lesson in leadership. So I think we're going to wrap up here. We will have a webcast in a couple months talking about, the outlook for 2019. So this has been a really good review of 2018, at the halfway mark of the calendar year, and towards the end of what traditionally is the proxy season for most companies. So thanks, Bill, Pam, Jason, and Lisa, for sharing your knowledge with us today. Before we break, I just want to let people know that we have some really good upcoming events. There's a webcast coming up on July 26th where we'll be interviewing Jeffrey Graham. He is the author of Dear Chairman, Boardroom Battles and the Rise of Shareholder Activism. There will also be a Governance Center in-person event in Washington, D.C. for Governance Center members on September 6th, looking at the job of the corporate director from the perspectives of auditors, regulators, and accounting organizations. And some of the confirmed participants include Bill Dunkey of PCAOB and Wes Bricker from the SEC. The next Governance Watch webcast with Cleary will be on September 18th at noon Eastern Time. We'll send out a flyer with the speakers and topics later on this summer. Again, for those interested in CLE credit or New York CLE credit, please download the CLE verification form, the evaluation form, complete them, email them back to the address on the form, and be sure to put the verification number 11537. For CPE credit, make sure that you've entered your full name and email address at the space provided on the website, and specify CPE, and that's at the bottom of your screen. Materials are there for download. I suggest you go through them. They're very thorough materials. And thank you everyone for joining us today, and we will see you next time.